A very good morning and welcome to Bazaar ki Baat. It was the second month of Indian markets ending in red, but we did see some turnaround in the US markets. Let me at this point quickly bring in Kshitij to get his views on the overall market. Good morning, Kshitij.
Yeah, good morning. So the Indian markets, as you said, have been laggards in the first month. This will make it the 2 straight months of draw for the Nifty 50 and Sensex. On the other hand, global markets have done well, which we can see in your slide. And the markets in India were jittery ahead of the budget. Like as always, there are rumors around change in capital gain framework, which made the market jittery. And then at the close to the month end, we see the Adani route hit the market. So the Adani, just let me talk about Adani Hindenburg saga for a bit. So it was the most talked about event during the last month, and it continues to be so. The research report which the Hindenburg firm came out with came at the worst time, just ahead of the 20,000 crore FPO which Adani had planned. Though the FPO went through with the help of non-institutional investors, retail investors largely refrained. The rout continued even after the FPO had gone through, as news surfaced that few private banks or few foreign banks have stopped accepting Adani bonds as collateral for margin loans to its private banking clients, so which actually worsened I would say, the feeling among investors. And we saw Adani Enterprises fall as sharply as 30% yesterday, post the budget. And now, yesterday market, we saw another news where we saw that the Adani has actually called off the FPO. So all this is continuing. So this is more like I would say, edge of the seat movie which is going on, and we have to see how it plays out. Uh, so overall, this is what has happened. While I would say the last month from the start of January, we see underperformance in Indian market, largely because FIS have been net sellers after being buyers for last few months. We saw that the foreign institutional investors are exiting India, and this is largely due to a rebalancing to global market because because after the China reopening, we saw a sharp up move in the China markets. There was obviously an outperformance in Indian market during the last year or so, which has made the Indian market more expensive as compared to its peers in the regional market and globally. So it's basically decoupling acting on both ways. We were outperforming when the regional markets were not doing so well, and now we are underperforming when the regional markets are doing well. So it's nothing I would say out of the ordinary. Yeah, this is more about valuation playing its role.
That's very interesting because for most of the time we talk about market dependencies, and decoupling was a topic of great interest last year when a lot of us were talking about how we cannot stay decoupled. So interesting point to watch out for. Coming to the sectoral side of things, we saw auto and IT being the underperformers throughout 2022, whereas they have staged quite a bit of reversal in January. So what is really happening on the technology side of things, Kshitij?
Yeah, so IT stocks were performing, had a dismal 2022. And last month also, like we had discussed that they had started some recovery in the IT sector. We have also, I have also talked about that the historical data indicates that during elevated interest rates, IT sector is actually IT exports have grown in India. So the Indian IT companies have actually performed well during even adverse times. So which gives us an idea how strong the fundamentals of these companies are. If we just see the Nifty 54 companies in the average revenue growth this quarter or the December quarter was 18%. And if we see the management commentary and the results, there are three things which clearly come out. One thing is that there is a strong demand still for cloud and automation. Uh, all of our large IT sector companies are doing very well in that sector. Indian IT companies are benefiting from vendor consolidation. What it means is that now that the big companies around the world are thinking about reducing their IT costs, they are actually selecting or consolidating vendors and selecting companies which they are already working with for a long time and are cost efficient. So where the Indian IT sector performs very well. Third thing which we see in the results is that the attrition and addition of employee both on both fronts are kind of stabilizing. So one thing which had benefited Indian IT companies is that they've not gone overboard during the last few years when the tide was in their favor and they're not recruited. So if you see globally, we are seeing the big tech laying a lot of people. While for Indian IT companies, that has not been the case. They continue to hire both Infosys and SCL. If you see, Tech have said that they will continue to add employees even during this year. So which is a positive sign.
All right. And what about the overall Nifty 50 companies' performance? We are already seeing results coming out, and what do you think is happening, on that side?
Yeah, so we are in the midst of result season. Around 31 out of 50 companies have come out with the results. The results have been a mixed bag, I would say. And there has been revenue growth for sure, around 3% or so. But as you said, we the markets track the fundamental. So the auto sector performance, which we talked about, we can see a good bit of auto sector companies doing very well. Tata Motors for its part have actually given its first quarterly profit after 2 years. So which is on the back of rising passenger cars demand and also heavy commercial vehicles. Maruti saw its profit double during this quarter, and banks as a basket continue to do well. So that is one I think a concentrate trade which is going on for the last year, but still continues to give good results. If you see what has happened, I see there's a long runway. The reason being first of all, the credit growth has come back. Double-digit credit growth is happening. Secondly, what we see is the bank credit to non-financial sector as a percentage of GDP grew very sharply in 1998 to 2010 and has since then stagnated at a level. While the GDP has grown, bank credit has not actually caught up. This has been below trend since 2010, and this is largely because of the NPAs. Now that the NPAs have gone away, we can see that there's a strong case for recovery for bank as a sector as a whole. Yeah.
Right, right. So, okay, so we'll talk about sectors in some bit again, but before
Mhm.
that, what is your overall view on the budget? There was so much of positivity in the markets yesterday,
Mhm.
initially during the first half of the market session. What's your view on the overall budget?
Yeah, so I think the budget had everything for everyone. Has something for everyone, not everything for everyone. It's something for everyone. That it pushes for growth, keeping an eye on fiscal prudence. Let's just say the first biggest takeaway for me, or the biggest positive, was that they did not touch the capital gain framework. So, which was, I think, the why the market reacted so positively. And secondly, at least in the start. And secondly, one thing which was I was pleasantly surprised that it was a pre-election budget and it was still devoid of political or popular measures, no subsidies. So this kind of gives us a inside view of how this government looks at the change in political scenario. They basically are betting on infrastructure development instead of doling out subsidies. So that has been a large, meaningful change which has come out in our politics and which is a very positive sign in going forward. If we discuss at the broader asset level, equities, as you said, corrected sharply after there was some amount of euphoria in the market. And this was largely led by fall in the insurance companies, which were hit by a tax, which I think we will talk about later. and Adani route continued. So that actually spoiled the market mood. On the bond market side, I think that the bond market rejoiced the budget, especially because the FM sidestepped any large populist measures. The borrowing is slightly lower than the market expectation, which has helped bonds. The government is focusing on raising more funds through the small savings scheme, which so basically the supply of bonds would be lower. And the major thing which I see is the math of the budget looks very realistic, which is a positive for bond market. We are, which what it does is it gives the investors confidence that there will be no surprises during the year, and there is scope with the government to deal with any surprises on external surprises if they come in. So nothing out of the ordinary has been planned in the budget, so which makes it a positive. Yeah.
What were some of the positives for some sectors?
Yeah, I think one big takeaway, as we can see in the slide, is that capex has again been boosted up by around 30%. This has been the third year in the row that the capex has been rising by 30%, which is a very positive sign. Having said that, the government capex as a percent of GDP is only 4.5%, while the private capex accounts for 26% of the GDP, as a GDP is 26%. So government capex, though government is trying to do the heavy lifting, but it's not enough. Uh, but besides the point, any capex is good, and has a multiplier effect on the overall thing. The sectors which get impacted are the usual suspects like the roads, uh, uh, cement sectors, steel, urban infrastructure, building materials. So the likes of any EPC companies like the likes of L&T, KEC, Kalpataru, and cement, we have Ambuja, Shree Cement, Dalmia Bharat, and many like those. So these were the usual suspects. We also saw that they have actually said that they will take 100 critical transport infra projects for steel, ports, and fertilizers, which have been identified, and they will invest 75,000 crores. This is again positive for infrastructure and steel companies. Similarly, there is a large outlay for railways. I think this has been one sector which has been largely ignored over the years, and almost this is 9 times what the outlay was in 2014. So it was a big outlay, and this is positive for companies like KC, RVNL, Siemens, Kalpataru, Titagarh Wagons. So all railway related companies. On the other hand, which what we saw is that the subsidy bill has actually brought down by the government around 38%, or sorry, 28% on the lower than the current year, which is quite surprising and actually a positive boost. So they are actually deploying money. So this kind of gives us the idea that the capital allocation has been done very well. So yeah, so that would I would say the big takeaway on the positive side with the capex and the railway outlay. There
Yeah,
have been smaller subsidy cuts and things like that, which will play out. But I would say the big or on the big headline is the capex outlay, and
correct.
that will be play out.
What about some disappointments? We didn't hear a lot about things happening on the defense side. And do you think there were any disappointments for some sectors?
Yes, so defense there has been outlay and there's been a focus on Indianization, but I would say the defense budget was lower than what was market expectation. So we are at 2%, somewhere around 2% of GDP on our defense budget, which is actually much lower than what our neighbors have, especially China. And now that we have seen some amount of issues on border issues creeping up in the last few years, the market are expecting that this may be higher. And obviously, if the defense budget is not so much, the shares of defense-related companies like Bharat Electronics, Bharat Dynamics, Hindustan Aeronautics, they fell by around 5 to 9% last yesterday. On the other side, I think one thing which was always a risk at the time of budget is that the duties have risen for cigarettes, and which like every time impacts negatively on ITC, VSP industries, both refill, so things like that. But it's
Right.
not. It's, I think out of the nothing unusual. I think
Hmm.
this is always a risk for
Hmm.
cigarette companies. And as we said initially, life insurance companies, they were hit by a tax change, and we saw around life insurance companies falling as much as 11% for the likes of SDFC Life and or ICICI Prudential. They fell sharply. So yeah, so these were the few of the disappointments.
Right. All right. So we'll just
Yeah.
focus a little bit. Yeah.
So now that we've talked about the budget impact on the sectors and the real economy, what has been the budget impact on us as individuals, or us as our clients, or as a business? What is the changes in the personal finance segment that if you can
Yeah, so on the personal finance side, there were quite a few nuanced measures rolled out, right?
Mhm.
Broadly, if we see that, we could clearly see that, the government was trying to focus a little more encouragement on the small savings side of things, especially for
Mhm.
the senior citizens. So, SCSS being
Right.
one of the primary, vehicles which senior citizens were currently using was very capped at a very low level of 15 lakhs. So anybody who is retiring with a corpus of 1 CR, they could have invested only 30 lakhs between two files so far, which has now been doubled. So essentially, a
Okay.
retired couple can now invest up to 60 lakhs into SCSS and get a quarterly payout. And the current interest rates look very, very attractive at 8%. So they get to lock this for 5 years, which is, I think, a big boost for the retirement segment. We had some measures on post office monthly income schemes and a new instrument rolled out, which is more of a temporary instrument for the girl, child, and women segment, which is Mahila Saman Savings Certificate. But both of these instruments are, little less attractive as compared to the current interest rate scenarios because the kind of interest rates we are getting on POMIS and Mahila Saman Saving Certificate. Again, similar rates are available for bank FDs, especially the MSSC certificate is a 2 year instrument. So I think the idea there is to encourage the smaller savers to start saving in the name of this instrument rather than to really, because the amount is capped at 2 lakhs again. Um on the other side, we saw some major, a shift in the way they were thinking about how the HNIs are operating in the country. So we'll be talking about the personal taxation with Vikas in a bit, but there was some tax relief to the HNIs, under the new regime. But a couple of things, that were taxed for them was actually people, who were actually taking high premium insurance policies. They were getting proceeds which were tax free, and there was this tax arbitrage both in insurance and in MLDs. MLD tax arbitrage is completely gone. So something that was taxed at 10% earlier is now going to be taxed at your slab rate. So anybody who was investing in MLDs, and most of these people were in the 30% tax bracket, will now not see the benefit of investing in MLD. So in a way, that industry is really going to be dead. Insurance, again, this tax arbitrage is a big, big boost for the mutual fund industry because this means that people will not, be inclined to purchase high premium policies from an investment standpoint, right? So the concept of plain vanilla term plans, etc., will start becoming more popular also. Another major thing that came in was that any capital gains being realized on sale of property, reinvestment of the same is now capped at 10 CR. So again, high value property transactions that were happening, where a lot of capital gains was being saved by ultra HNIs, is again now going to be hit. On the flip side, we might actually see a lot of insurance policies and house sales, high value house sales happening in the next 2 months. But post that, both of these things will see a curb. We saw an increase on TDS, on external remittance. So especially to, I think, to curb international investing, basically the government wants to discourage people to invest outside, send money abroad, and wants to, keep that money in the country. So these are some of these, I would call them nuanced measures, not very upfront available, but it's going to impact people in pockets for sure. Um, Coming to the personal taxation side, I would want to bring in Vikas here. Vikas, one question that a lot of people are, contemplating in their minds is, should we continue to be in the old tax regime? There was a new tax regime which was brought in, and there's a lot of confusion with this setup. So, what is your, take on this? And second, how do you think this migration is going to happen? What is the government trying to do here?
Hi, Stuti. So I think that the government is trying to nudge all the taxpayers to slowly move towards the new tax regime. This is not something that they are pushing very hard so that it becomes inconvenient or like looks like a push from the government, but there are soft nudges which is coming in every budget. This budget made it more clear by not offering any kind of higher deduction for the old tax regime, but making new tax regime more lucrative. So, like what I am seeing is that the new tax regime now would be more beneficial for a lot more assessees. So, how do I see is that if say the compliant the movement to new tax regime will be very high in the next couple of years because when we show you with examples, you'll see that you need a very high amount of deduction for old tax regime to be like beneficial for you. So when I was doing some number crunching, I saw that if you are in a new tax regime and if you're not taking any deduction, so if you have no deduction, then what happens is that, and if you are earning say 15 lakh rupees, which is where the like major difference happens, so you can save up to 1 lakh 12,500 by just going to new tax regime. So there are a lot of people who are not saving enough or who don't want to save. So that is their discretionary choice. But if say suppose they are earning 15 lakh rupees, they net save 1 lakh 12,500 rupees, which is like 10,000 per month, which is a very decent saving for anyone. Even if say suppose you are taking deductions, even then if we do a like a normal like so what happens is that I see with my set of clients that most of the clients are taking deduction under 80C or NPS. So these are the two deductions which is available to all the clients and medical insurance. But now that will not be sufficient because earlier what was happening is that the difference between the new tax regime and the old tax regime was 60,000. But with the introduction of standard deduction to new tax regime, now the differential is 1 lakh 12,500. So now you need higher amount of deduction or other heads of deduction to make the old tax regime beneficial. So if we do this analysis and if we see that if say suppose a normal person who is like earning say 20 lakh rupees, and if he is not if he is taking all the deductions which is available to him under 80C, 80D, which is medical insurance, he's doing his ELSS, he's doing his PF, PPF, and he has no other reduction. So he is not having a housing loan or he is not taking HRA. In that case, now the new tax regime will make more sense for him. So for him to stick to old tax regime, he has to have a housing loan or an HRA so that his total deduction is above 3,75,000. Then only he will start making some like benefit out of the old tax regime. This makes it like a lot of people may not be having a housing loan or may not be having an HRA. So the summary I wanted to summarize now this that if say suppose how do you now look because see this can have numerous scenarios. So the summary is first that you if you are having only 80C, which is PPF ELSS, if you're plus an NPS, then definitely you'll have more benefit under the new tax regime. So this is one thing which has happened. Second thing that what you have to remember is that now you get standard deduction also. In the earlier example, we have not taken standard deduction because that was more generic. But if you are a salaried or a pensioner, you are now getting a standard deduction in new tax regime also. So this makes new tax regime even more beneficial for anybody who's having income of say 10 lakh, 15 lakh, because this net 50,000 is again available to you. One thing what I have seen is that a lot of people who are like doing their tax planning with their HR, they miss out on one important thing is that the deduction under 80 CCD2 is available under new tax regime also. Now what happens is if say suppose if you are moving towards new tax regime, then you have to always think whether you want to do a PPF or a NPS, because a PPF will not give you a tax benefit under new tax regime, but an NPS through an employer can give you that benefit. So this is a critical point which can help you save a lot of taxes. If you are employed, if you are having an income of more than 15-20 lakhs, you can always rejig your salary to ensure that you save decent amount of tax. But it will always involve a personal choice between a long-term savings and investment of PPF versus NPS. 80 CCD1, which is a 50,000 per year investment, is not available under the new tax regime. So you should not confuse between employer contribution and your contribution. So only employer contribution is like available for deduction under the new tax regime.
Right. So if I understand it correctly, I think one of the things that we clearly see is that the government is trying to nudge people to move to the newer tax regime. And for old tax regime to now make sense for people, it will only make sense for those individuals who have a significantly higher level of deductions, let's say by, I mean, ATC, ATD is something that most people do, but over and above that, so if somebody has a housing loan or an education loan or, a big HRA, a big leave travel allowance, and culmination of all of these things exceed 3.75. In those cases, one might need to recalculate and see whether old regime continues to make sense. Corporate NPS is going to be extremely lucrative, even more lucrative for new tax regime people, because that becomes kind of the only way to save taxes. But having said that, I do understand that a lot of our viewers might still be confused that, what does make sense for them in terms of, whether they should continue with old tax regime or move to the new tax regime. In case you want your salary calculation to be done or your income calculation to be done and get a view on this, please feel free to reach out to us. You can send us a DM, you can send us an email, or you can just simply put in a comment and we will reach out to you and customize your query solution as well. So I think that is all from our end, and stay tuned for the next session.
Thank you.